Good afternoon. Welcome to Chicago Future of Finance. I'm Oliver Rinnick, live from the CBOE trading floor here on Jackson and LaSalle, and we have a pretty solid session underway with the S&P 500 just little changed, almost perfectly unched, despite a VIX that is fixed in the high 20s. VIX very much at the high end of the range that we've been at here, despite markets holding in, and that's with crude oil up right now 4.5%. It's also with WTI, continuing to stay pretty well bid as too, and bonds as well, which are down. So yields are up, bonds are down, crude oil is up, dollar's up, and the market is holding in just fine. In fact, some of the key groups are higher. SMH up 1%. That's really important. So I think that all things considered, this is a pretty good day. The fact that we're able to shrug off the main negative factors, primarily WTI. Talking with Uber driver on the way down today about the price at the pump and certainly an inconvenience. But we saw from the economy there's still some decent data out there as manufacturing and the composite, both for PMI flash today, were right in line with expectations and still above 50. So the economy is generally holding in. Also saw productivity and cost, though, kind of on the other end of that. So the data today were not exactly perfect by any means, but it could be a worse situation right now. There's the productivity lower than expectations. That's not really good. You kind of want that to be going up to justify the AI disruption. Unit labor costs also up, so inflation certainly part of the dialogue here. But there's PMI composite flash holding above 50. A lot of these data have continued to be pretty strong. The other thing I would point out is that we're doing all of this in the middle of a government shutdown. Travel is an absolute disaster and a mess in a lot of places, especially if you're dealing concurrently with spring break. But the odds of the U.S.-Iran nuclear deal have inched up a tiny little bit, and we actually just also saw President Trump talking about the potential for Russia and Ukraine to sit down. But my view is that with crude oil up today, the commodity market is not really buying that story. Crude's still at $91 and higher on the day, not necessarily interpreting any of these geopolitical headlines as particularly positive. So the fact that markets are holding in, despite crude not feeling positive about those geopolitical events, maybe the market is stabilizing, but also just keep in mind here, the real important thing is that VIX is pricing us for a much bigger move than we are getting right now. You pretty much have had this set up many times around this time of day over the last 2 weeks, where you have two options to look at VIX and say, okay, stocks are going to break down. I mean, VIX is down pricing in like a 1.6, 1.7% move. That's a big deal, and we're way far away from that right now. I generally like to go with the price action for the stock market as my main sort of benchmark for understanding the session. So the fact that you've got Tesla up, you've got SMH up. We're going to talk a little bit about the MAGS group, which is down today, but if you look at software, that group's selling off after a pretty nice bounce late last month. That's unwinding. There's certainly some trouble here. There's certainly some nerves that remain high, but for the S&P to be right now little changed, basically unched, despite VIX being way up, still pushes me to want to generally fade volatility. So maybe we're getting to the point where you have to have increasingly bad news to move the market lower. Yellow on the risk radar as a result. I do think that some of those lights are pretty close to changing on the macro side, especially if you look at the 10-year yield, which is pushing higher again today. That is starting to become an issue. But again, that one I also don't necessarily think has to be a completely bad thing. Keep in mind that at the beginning of the year, I was looking for bonds to sell off in general, selling off for the right reasons. Maybe they're selling off for the wrong reasons. But what's important is that the market is just in a complete state of unknown right now in terms of the macro backdrop for interest rates. If you look at the odds right now of a cut or a hike, they're almost even. This is from Joe Cioli's great morning note at Business Insider. Check it out. And that's a very fascinating spot when the odds of a hike now by the end of 2026 have moved above the odds for a cut, but they're basically right there at the same point. That is a critical juncture for markets where there is a massive amount of uncertainty. We're going to be talking about that uncertainty as well with Sam Rowe, who's joining from the show today, who writes the great newsletter TKer. So we got a lot ahead of us, a great program here over the next hour on Chicago Future of Finance. Let's start by bringing in Hans Albrecht, joining us, CEO of Options with Hans. Hans, welcome back to the show. Good to see you.
Oliver, great to see you too.
So tell me, firstly, from the top line here, I mean, I feel like it's worth oversimplifying in cases like this today because the rule of 16 on VIX tells us this market should be down or at least moving like 1.7%. And we're nowhere even close to that. We are onch. How long can VIX stay this bid with the S&Ps not moving?
Yeah, I mean, look, the VIX is absorbing other things, right? So you're absolutely right. Based on movement, it doesn't seem justified, but it is. If you look at some of the undercurrents that are happening in the market, we've talked about this before, where the index isn't doing a ton, although it's made a bit of a move lately. It really is those underlying components that are sort of going in different directions. That dispersion is very violent in many cases. We see software turning down again after having that nice rally that you mentioned. And so I think it's absorbing some of the credit problems. It's absorbing a little bit of geopolitical. And so it's not that unusual to see the VIX kind of absorb a little bit more than is perhaps justified. But when you look at the charts of banks, if you look at the private credit, private equity type entities, not looking good. If you look at HYG, high yield, I mean, there are a lot of signs out there that things are not. The market's not happy underneath the surface. And so I think it's a reflection of that. So on the one hand, you could say, well, maybe the VIX could even be higher, like get it over with, figure this out, get it over with. Let's hit 35, 40. Let's have the flush and then to business.
Well, that's interesting, Hans, because Friday seemed like a really big opportunity for that with monster expiry, and then the follow-up yesterday too did push us above 30, but it couldn't hold. Am I wrong to read that as possibly optimistic, that there was an opportunity there for that flush out and just the bears didn't have the power to bid vol any higher?
Yeah, but I mean, look, if you look at the chart, I look at every chart I look at, everything's kind of pushing back up to that 9 EMA. That's kind of one of my favorite spots. Some people like the 8, some people like the 20. So many stocks keep going up, tagging. The SPY did it yesterday, tags that 9 EMA and just can't get going. So right now, a lot of stocks are trading below that 9. They're really not looking that great on the charts in general. And I think that is indicative of a market that is not in a good place right now. And if you add in all those other things that I talked about, the XLF, the HYG, we need this market to really kind of show us some signs of health. And right now, it's not happening. And it certainly doesn't help that the mags are breaking down as well. We've talked about this a number of times over the past couple of months. You look at Microsoft hitting new recent lows again. And I've said, I think tech is going to struggle this year. I think some of these very big companies are suddenly somewhat vulnerable, right? Like I think it's not unreasonable to say that there are some difficult conversations happening in boardrooms of even the very biggest tech companies, because AI is really attacking the value of the old software stack. And that has been a tailwind for the US market for a couple of decades now, right? This whole idea that, digitizing the economy, renting out access to software and services and all that stuff, make all this. I mean, they made boatloads of money. This is under absolute attack right now. And you're seeing it continue to play out. These stocks are having a lot of difficulty rallying.
The pullback in the software names is interesting. I also think the pullback in the private equity stuff is interesting. Let's just go to software first, because the private debt, private market conversation of Apollo and Blackstone involves quite a bit of kind of macro speculation, if you will, which might be worth it. But just to look at the chart on IGV, it was interesting that this group had rallied when the broader market had been really buckling. So if I plot IGV, the software ETF, next to VIX, it was going up when VIX was surging. I don't want to get carried away with that, but there was this kind of bottom fishing thing that was happening where that group was actually outperforming during that big VIX spike. So now that it's coming off, I don't think that's a good thing necessarily. There are some really important companies here, like to your point, Microsoft. But if the alternative to geopolitical chaos is we kind of go back to the AI-driven theme, maybe that's a preference, but I hear you in that generally some of these big companies in this group, you probably would rather have them stable than not.
Well, look, investors are taking sides here, Oliver. So they're saying, listen, anything that can be coded, anything that sort of exists more purely in the digital realm, are you making operating systems? Are you making software? Do you charge people for things like that? then you're very, very disruptible. Now, if you're Apple, notice Apple, it hasn't had a great time the last few weeks, but it's hanging in there right now because it is the physical part of AI. It's the physical part of the sort of theme. And AI isn't going anywhere. The build out continues. If you look at some of these sort of infrastructure names, materials, those are some areas that I still like because I have to sort of act like many investors are acting right now, which is let's try to figure out who is going to have who doesn't have visibility over the next 4 or 5 years and who has better visibility. Well, I know we're going to be building more data centers. I know we're going to need more copper. I know we're going to need more glass for photonics and certain technologies like that. So people are starting to really kind of, it's very bifurcated, right? The MAG couldn't be much more different. You've got a couple stocks, Amazon, incredible logistics business, a little bit of cloud, but more like the everyman's cloud. I think that still does well. Microsoft, not in any of the right places. Meta doesn't know what the heck it's doing. Google's in a great spot too, but look, I can go out and I can, with my Claude code, I can create a browser. I can create a number of different things that help me in my life, very customized to my needs. And I don't need to go out there anymore. So and use every product that you used to have to pay for. So that's a real reality for these companies.
Totally. I actually got a great tweet from that. I want to pull up from the often very funny, but also often very insightful NetCap girl, Sophie. Claude Cowork is making me think maybe we'll look back and it'll be obvious that humans were never meant to spend their lives working behind a screen. We'll see it as inevitable that computers do everything for us on computers, and the future of work is cooler than we can imagine. That's been my view. That has literally been my view, and I love the way she put it because that's generally what I've thought, is that this is going to create opportunity for us to engage our creativity and do other things using low-cost robotic labor, basically, or AI thinking. And we're definitely not meant to be behind the screens and sitting down. Hans, my lower body flexibility and health is proof of that. Like there was way too much sitting going on.
I want to go golfing. I want to go skiing like Pete Najarian always seems to be skiing.
Yeah, that's hopefully me on Thursday. We'll see if the powder's any good out there, if it's all melted away.
Out in Colorado. Right. You're heading out to Colorado?
Yes, sir. That's the idea,
nice.
But apparently it's all melted down.
Yeah.
I don't know. We're going to see. Scott Bauer is literally going to be on the slope at the end of the day, so we'll see if he's got any snow.
Well, give it a try. I was out in Big White a couple weeks ago, and it was just beautiful. It's one of their worst seasons in the last 3 decades, and we just happened to nail a really good week. But to your point about computers, that was a great point you made, Oliver, about computers doing, kind of doing all the work.
The computer things.
What's that?
The computer's doing the computer things.
Computers are doing the computer things, and that's why I think there's sort of an interesting play. So, in that kind of agentic basket. So this whole idea that we are the bottleneck, right? We're the slow pokes in this whole process. When AI agents start working with AI agents and transacting and communicating and building. And there was somebody's talked about this Minecraft where they put 1,000 agents in this Minecraft game, and they were creating they were creating all these crazy things. They were creating art, and I mean these things can really have a life of their own, personalities of their own. It's pretty incredible what is already capable. And as we move to this world where the transaction layer is going to have to be absolutely super lickety split fast, that's going to bring into the forefront, crypto and some of the layers that are necessary in that area. So that's kind of one area that I'm a little bit positive on, as well as the other sort of drop things on your toe. I think that's still valid. We've had nice pullbacks in things like FCX and copper, and I think those remain kind of interesting places.
FCX, what about the kind of metals trade, SLV, GLD? Those got really smacked over the last couple of weeks, Hans. I wonder if the software pullback here, if that's a sign of reverting back to our core AI theme, which was good for some of these metals. To your point, the drop it on your toe trade, is there an opportunity here to try and buy dips on some of these?
Absolutely. I think that is one of the best places to be, because as I said, I think if you look out, you understand that there's still going to be this build out. It's a matter of national security. It's us against them. It's China versus this is happening. And so I want to position myself in those places where I know there's going to be demand, where people are going to be fixing up electrical grids. They're going to be updating, retrofitting. They're going to be doing all that stuff. That makes those things are sort of very, very interesting to me. Absolutely.
Okay. Hans, in terms of tech trades and stocks as well, you mentioned Meta and Amazon as kind of more being in the right place, perhaps. One of the trades that was just the absolute worst loser, or the biggest loser, was Adobe in the software category. That's making new lows again today. So if that is our guiding light for AI disruption, it tells us there's more to come, it seems like.
100%. Adobe just had that nice rally there. It got kicked in the teeth again, making new lows today. Salesforce not quite making new lows, but pulling back as well. So I think this is that's the lay of the land right now. Is if you are just the thing is, you've got to remember that these agents, AI is basically, from things that I'm reading, is improving, is doubling in capability, however you want to measure that, every 6 months. So this stuff is only going to get more and more powerful. The ability on Claude, you can just go out and make a widget. I can say, listen, give me create a bit of software for me that shows me the VIX doing this and that, and when something breaks down, do that. It will create it literally right in front of you. That is a very difficult place for a company to be in that used to sell that kind of service, and that's the reality of it. Is that in a year from now, it's going to be way better, and that's just a durable headwind for those companies.
I got an example right in front of us. Actually, now the stream is live. It's a little hard to see, but my today's graphic for the show. I needed to plug you and Sam Rowe into our graphic, and there was no Adobe involved. There was no Photoshop. I went online to a service. I used ChatGPT to remove the guys who weren't on the show today, and then I used a different thing online to just plug you guys in. That's it. Look, I love my graphics guy, but I can do it on my own. It's not hard.
And it's not fair. It's not fair, Oliver. The last thing I'll say is it's not fair. When you think about it, whatever it is, Claude spends $13 for $4 of revenue, right? So what's happening is you have these incredible tools out there that are increasingly able to do almost everything. And once you start to get into automation and robotics, which is right around the corner, they are literally going to be able to do everything. And they're being subsidized. So how do you compete with a company that can suddenly do everything? It can lose boatloads of money to disrupt you and basically mow your lawn. It's almost unfair when you think about it, but that really is the reality of things right now. People have a genius in their pocket for $20 a month, and it's very difficult for traditional businesses to compete with that.
Yeah, hey, that's capital markets, baby. Sometimes it gets nasty. Hans, great to catch up. Good thoughts on tech. Resuming the software short in the susceptible areas to AI seems like a big message there, and you've been on that for months. Appreciate you bringing it to us again. Good to see you.
Thanks, Oliver. Take care.
You got it. Hans Albrecht, CEO of Options with Hans. Let's go to the gambler here. I got John Najarian standing by, as there are some interesting bets happening on some of the poly markets and Kalshis of the world. John, good afternoon, sir. Market Rebellion co-founder. What's up? I'll make sure you're unmuted for me, John. There we go. I'm going to pull up. You make sure you're unmuted for me, John. Smash that unmute button there if you got it on.
There we go.
There he is. There's the man. Hey, what's on the hat there? What you got?
Tripping birdies.
There you go. You out golfing?
The Masters is coming up in a few weeks, my friend.
There we go.
I will be down there with a number of companies that I support, like Magnifica Air and some others, but it's going to be fun.
Nice.
And,
I want to get in on that.
It's always a good time.
You need to get Narrative Capital in on that group.
I think I need to get you down there. Maybe we'll have to host a panel from there.
I'm working on my golf etiquette, John. It's not the best, but with time, I'm learning. Hey, let's talk about, while you're traveling, maybe let's start with the shutdown situation, John. I'm kind of surprised that the airlines and whatnot have held in as much as they have, despite crude oil where it is, and then this shutdown of Department of Homeland Security and TSA being a mess. It doesn't look like, according to a poly market right now, that there's a lot of hopes for this to end anytime soon. Maybe it's gone up a little bit, just marginally here. After March 31st, dropped, and between March 24th and 27th, went up just a tiny, tiny bit. But it really depends on the start date for this. If you go back a week, it's gotten worse.
Yeah, well, I think that creates an opportunity. And here's why. Because Trump is now saying he's going to make the ICE people at the airport permanent. And that totally screws Schumer over, because what was the reason that he was withholding the money for TSA? It was because he wanted to negotiate better terms for ICE and their abilities to deport people and so forth. Well, they're up to 1,100 persons per day right now. And despite what people might think, they're getting them at the airports as well. So Schumer more or less is being foisted on his own petard, if we were to take a Shakespeare reference and say, you know, when the tables turn like this, I would say buy that when will DHS shut down? I think it does end by the end of this month. I think by next Friday, basically the 27th, we're pretty much done with the shutdown. So I'll be surprised if that doesn't start moving, Oliver, because of this move. It was very efficient. The fact that they're scanning people before they get into the airport for TSA and so forth, and they've taken over the security part where when you leave the airport, of course, there's always a TSA person, not private security, but TSA, to make sure somebody doesn't go back up the escalator and get into the airport without being screened. So now those jobs are being taken up by the ICE agents. They're not screening the luggage. They're not doing the pat downs or any of that.
Right.
The people that have those training skills, putting them on the machines. So with all of the folks that haven't been paid not coming into work, they can speed through the process a little bit better. So that's why I'd say they lost their leverage as soon as Trump did that.
John, the airlines group is, just looking at the chart of JETS jets, holding in pretty well. I feel like there's got to be a message about the consumer right now that is way more resilient than people think. Able to fly, able to shell out for gas, able to shell out for small luxuries, you know, even though this group got hammered over the last, call it month and a half, it's actually found some support down here.
Right. And I think where that's exactly playing out is because of spring break and people that are in the cold like you up in Chicago versus me down here in Puerto Rico, people want to get to places like this. They want to get to Florida. They want to get to the beaches and or play golf somewhere. It was 100 degrees last week when I was in Vegas looking for a table for you. So,
yeah, that might be a little too much, 100 degrees. Woof! That desert heat can sting.
We were hot, and that's in March. But I think the more of a challenge is going to be what happens in the next few weeks, given the lines that people have seen and so forth. Now, if they actually start showing how much those lines have decreased, like at Atlanta right now, they're back under 30 minutes for the long lines. And if you have TSA pre or clear TSA, you're probably way under 10 minutes in the wait. It's not the 3-hour waits anymore because ICE has been deployed at some of those big airports. Dallas is easy. Houston is bad. So that's how they're picking which airports to go to now, is which ones are showing the longest lines, and that's the ones they're showing up at.
Yeah. People are clearly determined to travel, to your point. People are determined to, still have that kind of post-COVID freedom. And a lot of people still have a lot of flexibility in the work schedule. So maneuverability, still a big change, a framework change over the last 6 years now. Let's talk the odds of a U.S.-Iran deal here, John. My message generally to viewers has been, good luck trying to trade this. But at the same time, I understand that monitoring these odds is important to trying to figure things out. And here's what I would say is that, in the last couple days, U.S.-Iran deal priced by Kalshi has moved up about 10 percentage points. It's, obviously it still is at best a coin flip for before 2027. Before August has moved up to 40% though. Do you think there is a trade here?
Yes, I think there will be. Is there right now? Like you say, it's a coin flip. If it goes back down the 10% that it just rose, I'd say that's better odds for me as a buyer of picking that thing to end by, for instance, by August. But things that Israel has done, things that the United States is doing, and not disrupting the entire energy grid by shutting it down effectively while they negotiate right now, it gives Iran and whoever the new leaders are, it gives them some time to hopefully get to a place where they would give up these various weapons so that we'd stop the campaign that we started February 28th. If they don't, I would say Israel and the United States would go right back to it, and that is not what the people that would like to be running that country would want to see.
John, last week you were talking about holding off to sell volatility until VIX starts to push further towards the highs. I want an update from you today because we are at the high end of that range, maybe not the peak of 35 we were just at, but we're sitting at 27 vol with crude oil up, with bond yields up, and the stock market little change. So, I mean, that tells me that equities are putting up a very strong fight here. I wonder if this is a better place to start selling this volatility. If crude rallying and yields up cannot break this market right now, are we starting to get some hope building maybe?
Yeah, and that would be, like, just as you said, in the 27, 28 range, I'm a much better seller up there. Because look at what the market is doing right now. As we're talking, the Dow is up 55 points, the S&P is down 7, NASDAQ is down 0.5% or 115. None of those justify a 27 or 28 or even close to it relative to your VIX for the spot. So much better odds for people that favor people that are taking on that risk of selling vol at 28. And I wouldn't be buying it back in until it breaks 23 or even 22, which I think would be in the cards in just a day or two of calm over the market.
Day or two of calm, that's the key part here. Hey, John, before I let you go real quick, any other trades that stand out to you? Any options flow we should be aware of that you're watching? You got one that comes to mind?
Sure. RKT, Rocket Companies, these guys are not the RKLB, Rocket Lab, but this is Rocket, the mortgages and so forth. Obviously, somebody's putting on a bet that after a big pop in rates, that they come back down and people come flooding back in. That's one. And Urban Outfitters, we're starting to see some upside call buying at that stock at 62.80. They're starting to come into URBN.
Urban Outfitters, all right. Trying to hold some support there. Hey, Free People is a very popular brand. And, if we're looking at the message, if the message from the airlines holding in despite crude oil up, despite the Homeland Security mess, is that people are just eager to treat themselves in some way or another, then casual shopping at mid-priced outlets is in that category. Because let me tell you what, 60-degree day in Chicago this weekend, busiest I have seen Gold Coast. I mean, it was shoulder to shoulder on the street. It was like you're inside almost. That's how crowded it was. It was like Disneyland or something. So
love to hear it.
People still got it. They were lining around the block for Skims. So, hey, John, you've been. Yeah, exactly. That brand's cooking. Thanks a lot, John Najarian. Appreciate it very much. Great thoughts today. Nice look at the Kalshi and the odds there of some of the government-related stuff. John Najarian, Market Rebellion coming up. We got a great guest, Sam Rowe, joining me from TKer. We're going to talk about one of the most important charts out there right now, which is basically the coin flip between a cut or a hike. There's the chart from Joe Scioli at Business Insider. Sam Rowe coming up after the break.
increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovator's floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
All right, welcome back to the show here. We got stocks still a little changed, but we did drop a bit there. The S&P 500 now down about 10 points, so losing some of our bid. Hopefully we are not closing the gap with VIX, which still remains quite elevated on the day. S&P 500 did lose a little ground there, but we're still doing pretty good with crude oil at $92, a 4% rally. And a great deal of unknown on the interest rate front as well, talking about the unknowns and how Wall Street is interpreting it, as well as the whipsaw of this market. Mr. Sam Rowe, author at tkayer.co. Sam, great to have you back on the show. Good to see you in Vegas.
Yeah, good to see you again.
Congrats on your poker tournament win, by the way, for the Money Show.
Yeah, I wasn't expecting that, but I appreciate the tips that you gave me going into that.
I was expecting it. I had a feeling you were going to take it down, man.
It's I think when you go into something like that not expecting to win and just hoping to do okay, you end up doing better than you do because you put yourself under less pressure.
That's right. You don't level with yourself. You just play the cards. But hey, you're good with numbers. You're good with logic. You're good at reading people. You do a lot of reading people at TK, where you are constantly going through the Wall Street analysis. So hey, my view on cards is basically if you got those skills, you just got to learn how to channel it into a few little categories of poker. Tell me the way you are reading the Wall Street tea leaves right now at TKer. And as you do that, I'm going to bring up one of the charts that you included, which I believe was from Hartnett's fund manager survey about risks. You put up a recent post that the thing I really want to emphasize is that nobody knows, which is actually a Powell quote, right?
That's right, yeah. So last week, after the FOMC announcement and Fed Chair Powell gave his press conference, one of the things was he was asked a follow-up question on what he thinks the ultimate effects of the war and higher oil prices would be on the economy. And he said very elegantly, quote, "The thing I really want to emphasize is that nobody knows," unquote. And, it actually connects very well to the chart from Hartnett from the B of A fund manager survey in that, so B of A conducts this survey of fund managers every month. And one of the questions they ask is, what's the top tail risk? Basically, what's the big risk that fund managers think can destabilize markets? What's great about the most recent survey is it was conducted after the attacks on Iran, and of course the top tail risk identified by fund managers was geopolitical conflict. 37% of fund managers said this was their number one concern. So this is what everyone is now worried about. What's interesting about this chart is it also shows last month's result, which had 14% of fund managers identifying geopolitical conflict as a top risk.
Oh, I see. Okay. So blue is the last month, and then gray is Jan. So actually, there was some up and down for this. At the beginning of the year, geopolitics were concerned, then they came off, and they went back up big time.
Exactly. And what this tells me is going into March and the attack, This was just not a risk that just wasn't priced in. The likelihood was not priced in. And as a result, you have everyone sort of scrambling in to price in what may or may not come of the Iran war and higher oil prices. So the first step of the market sell-off is just the uncertainty premium getting put into the markets. Not even the ultimate risk of the impact of higher oil prices and all of these things, which, by the way, has really yet to show up in a material way in the economic data. Some of the early reads from the March data says people are still shopping. They're spending a ton more on gasoline, but they're still shopping. And
Bingo.
for the most
We were just
part,
talking about that. I don't know if you heard the last segment. We were talking about that. It was absolutely just lines onto the street in Chicago last weekend. I'm not exaggerating.
yeah, and every day we see how crowded airports are.
That too.
Why wait 3 hours when you can, rebook, reschedule, do your business meeting over Zoom or whatever? No, people are out there doing stuff and spending money. This actually speaks to something I think we talked when we last talked in Vegas, is that consumer and household finances, while they're not as great as they were maybe 2 years ago, there's still some flexibility in there for consumers to spend. So they're still out there going spending. And on the flip side, we haven't gotten any major warnings from corporate America yet. They've had 3 weeks, going on 4 weeks, to begin to assess how higher oil prices are going to affect their 2026 results.
You're talking
on top
earnings.
of their, I'm talking about earnings, yeah, as well as their Q1 results. Now, it's possible as the quarter comes to an end in the next week and things ramp up for earnings season in mid-April that we get some of these warnings. But we really haven't gotten anything yet. In fact, last week, Delta comes out and says, despite all this stuff that's happening, we're sticking to our earnings guidance, and we're now increasing our revenue guidance, presumably because some of these oil prices are going to be passed off to consumers, who, by the way, are still going to the airport. Yeah. So that's an economic story. But for now, what seems to be happening is, from my view and from my read on the Wall Street research and stuff, is the traders and investors, figuring out how to price in this conflict and what it means. And we talked about this briefly before me coming onto this. But on one day, the war is over, and then the next day
it's World War III.
It's World War III. And we keep going back and forth from these headlines,
Exactly.
And it's no surprise that the rallies have failed to hold.
Hold that thought. I want to come back to that. I just pulled up the Delta headline from March 17th because I do think that was important. The rise in their revenue is almost 10% year over year. The fact that they held that on, and the fact that the Jets ETF has managed to find some support. Obviously, it came off significantly here over the last several weeks, but it has found some degree of support in Delta too. So that, I think, speaks to the consumer. Come back to the point on earnings for a second, Sam. You're saying that so far, generally, there hasn't been a sort of inflation input to those earnings in a negative way?
No, if anything, the earnings estimates have been going up. That's the craziest thing, because it's a complex economy, right? There's other things that are going on, and as much as things like oil prices and oil costs are affecting the consumers of energy in a negative way, those same customers, whether they are businesses like the airlines or households that have to fill up a tank of gas, they're still spending in ways that support the other companies in the S&P 500 and the stock market or whatever. And then on the flip side, there's also the companies that are going to benefit from this, because we hear this 1,000 times in the last couple of years, but the U.S. is a net exporter of energy. And with the shale boom and all this stuff, there's just there are these massive energy companies like Exxon and Chevron that are cleaning up and getting a little bit more margin now because they can sell their product for a little bit more.
Yes, and that's where I think the smart investor maybe at this point needs to think about energy as kind of a way to hedge through this. It's kind of an analogous point that I've made about AI. If you're really worried about AI, then maybe invest in the disruptive AI companies. If you're worried about oil, Exxon and Chevron, I mean, that was like a single-digit portion of the S&P, and therefore a lot of people's portfolios for a long time. You can keep equity exposure, shifting it over. You get dividends from that, and they're going to have a lot less volatility than the actual commodity does. Obviously, crude oil's been swaying back and forth lately after making that crazy 130 high, but Exxon today, pull up the chart right now, I mean, is making fresh new records, new 1-year highs as we speak. So there's definitely a way through this. The other thing that I think is really important, Sam, that you touched on with regards to that chart is that look at trade war down there in single percentages. Okay, a year ago, that was what, VIX, what did we get to on that? That was wild, VIX 60 on the trade war stuff.
Yeah.
Okay?
Yeah.
And to me, trade war and geopolitics are very overlapping. There's a lot, because back when when I was doing the show around the trade war time, I would have sort of approximated that. I just said geopolitical uncertainty, right? It's politics across the world. That's what trade is. So this is a different form of that. And I feel that generally that is the biggest brick in the wall of worry that allows people to buy dips in the market to sustain. That being said, number 2 on the list, inflation, is a different story. That's something that can lead us to sustained bear markets like in 2022. So tell me what you think about that.
Yeah, I mean, the geopolitical conflict and inflation, kind of go hand in hand, right? The reason why people are so concerned about the geopolitical conflict is because of what that could do to crude prices and inflation and everything, and how that affects the economies around the world. But getting back to what you mentioned, I think this is very important about how low trade war is on this list. Last year, I don't have the information in front of me, but last year that was much higher on the list of risks. And the trade wars are ongoing. This has not been settled. There are still tariffs being issued, and there are still levies and there's still these negotiations, and supply chains are being moved around. But I think it is. I hate to use these cliches, but trade war is currently a very well-known unknown, whereas geopolitical conflict and war with Iran is sort of is still in this phase where it's an unknown that's becoming priced in. So there's a world, there's a scenario where a couple months down the road, we still have this conflict in Iran in some form or another, but then geopolitical conflict falls off this list of top risks. Now, if crude prices remain high, it's possible that inflation continues to rise, but we decided that geopolitical conflict is not a concern anymore, even though the war is ongoing. Which, by the way, when Russia invaded Ukraine, geopolitical conflict spiked on everyone's list again, and they are still at war. But we've gotten used to it. The calendar has lapsed on all these things, and suddenly it falls to the back of our minds as the world adapts, the economy adapts, businesses adapt, supply chains move around, and consumers and businesses go on with their lives.
It's the John Legend market. Everybody knows that nobody really knows how to make it work. Okay, Sam, I got one more from your note here. If we talk about tech, someone in chat wants me to ask you about tech and CapEx. I wonder if they saw our interview from Vegas about that subject. And one of the things I found from a recent article of yours, tech job openings, showing how this has been this interesting shift, obviously, to kind of some old economy stuff with hardware making a comeback. Tell me how you're thinking about tech right now, the potential for the kind of AI disruption bubble and any of those CapEx write-downs that might happen over time.
Yeah, I'm not sure if this chart was for me necessarily, but I will comment on that.
Oh yeah, sure.
It is extremely fluid situation. It's crazy how bullish everyone was on software, a couple of months ago or a couple of years ago. And, hardware was the thing that everybody wanted to get out of because nobody likes to be in capital intensive businesses with, depreciation costs and all these things that you have to keep up. But it happens to be the case that hardware is now, well, it's cooled off obviously in the last couple of weeks and months, but hardware is very much a hot business.
Yeah, it has a place to be.
Ironically, if you want to talk about capital intensive businesses, the energy companies, refiners, and those that fit into that category. As far as jobs are concerned, there's a lot of news and reports of everything from very little hiring to a lot of layoffs happening at tech companies. I think, video game maker this morning just announced another cut to their workforce. And I think there was a report about Spotify cutting and all this stuff. People who work in this sort of software, exposed business. I don't think it surprises anybody. Anyone who has, spent even a little bit of time on some of these new tools that are out there understand that, while you might not replace, the chief engineer or the chief product officer, there will still need to be people who are involved in these functions. Debugging code and all this stuff still requires someone to actually look at this stuff. That said, a lot of the more tedious and but tedious tasks, it appears are being picked up by the machines.
Yeah, very true. Adobe making a new load today, one of the key ones in that category, total disruption. I made today's thumbnail for the show on some non-Adobe Photoshop online thing. I took out the other guys on ChatGPT. ChatGPT, though, you know what I should do? ChatGPT can take people out of the image, but ChatGPT cannot put people in the image. But that being said, it certainly has helped, quite a bit. And Sam, a great help from you as well. Let me see. Hold on. Let me see. I'm gonna get your reaction. I'm gonna pull this up here. This is so funny. ChatGPT just can't do this. Before I let you go, I'll show you my process. Okay. So hold on. All right. So here's the usual image. Hold on. Let me pull it. This is so funny. All right. So here's the usual image on the top right. Okay, and I said, please remove the guy on the far left, second to left and far right from this image, because, we're changing it for the day. Beautiful, okay? Please put this guy on to the left, and then this is what we get. Who is this guy here? I don't, it's crazy. Who is that there?
Yeah.
In the middle.
Right.
Look what it did to look what it did to Scott, and look what it did to Pete. So then I had to go and do it on a different platform. But oh man, so funny.
But this is such a great example of what I'm talking about.
Right. AI gets you halfway there.
It gets you halfway there, but there has to be someone closing the deal.
Exactly. Oh man, hilarious. Well, that's me as I don't know who that is as me.
Yeah, you
Sam,
look great.
Yeah, I guess so. Appreciate it, Sam. Great to have you on the show. Fun stuff. Appreciate your time.
You bet.
Sam Rowe, author at tkayer.co. All right, we got 12 minutes into the bell here. Shorty break, and then Scott Bauer is joining us from the mountaintop. We'll be right back. All right, we are back here with 10 minutes left. Stocks trying to hold on into the close. Mr. Scott Bauer on the slopes. I guess that means it cooled off a little bit there, Scott.
Yeah, it did cool off, but it is pretty darn slushy, which is why I'm down here right now at the bottom. But you know what? You do what you can do, just like in this market right now. You do what you can do, not try and overdo it. So it's all good.
Don't overdo it. Don't overdo it.
No, it's all good.
By the way, let me just say the coolest piece of tech is what you've got clipped on there to your collar, that speaker, right? That's the music, right? Those things are so cool.
The music. It's by Nox Gear, Noxgear. You get it for about $30 on Amazon.
So what's the report? You in Beaver?
No, actually the Vail today. Vail is much better than Beaver.
All right.
Bat bowls are closed, but I'm down here right at Gondola 1. And it's pretty slushy down here, but we found some good stuff to navigate. It's all good, but it's definitely about 70 degrees.
You know what? The ChatGPT did me a service because I'm heading out there, and I typed into ChatGPT, what's the best mountain to ski this coming week? And it gave me a whole...
Copper?
Well, that's what it told me. I got to update it, but that's what it told me on Monday. As of Monday, it said, based on where the mountain face is and current reports and lines, it's pretty helpful. It's pretty good.
I would check it one more time before you come out because it is changing really quickly.
Yeah, all right. Market changing pretty quickly, but one thing that's remained consistent here is volatility remaining quite bid.
It is.
The question of my show today basically has been, do you fade it here? Do you have confidence in stocks to stabilize with VIX at 29?
I think you can fade it on individual stocks. Maybe a short-term trade in like SPY, triple Qs, you can fade the volatility. I'm not saying, fade a direction, but I think you can still harvest some vol. But I would keep it closer. And the reason I would keep it closer is because the further you go out, if volatility remains higher, the Vega component, one of those option Greeks, the Vega component is going to affect those options that are further out in time. Where if you keep it a little bit closer, like, a few days, maybe within a week, you have a much better opportunity at harvesting a lot of that time decay, that beta. So, we've talked about this incessantly, and I'm still doing it, these iron condors, Oliver, which is really a way to kind of fade the volatility and harvest that premium. We put out another one on Micron today. I've just been doing them. It's been rinse, wash, repeat. And to me, that's the best way to harvest this volatility, because even if it does move a little bit higher, you're not going to get hurt by it.
Okay, so the idea of Micron pulling back volatility, going up a little bit there, making that trade juicier to squeeze?
Yeah, absolutely. And down, this one was a bullish bias because Micron coming right down to that 50-day moving average. So definitely sold a put spread and a call spread, but the put spread is closer to being at the money. So you take advantage and get a little bit of bullish direction out of that. But still, you've got both sides where I'm collecting premium. And it's there's a lot of premium to be had out there doing it completely risk-defined. A lot of people think that, if you're selling premium, it means that you're selling naked calls, naked puts. It does not have to be that way. Everything can be done completely risk-defined.
Okay. Micron, too, an interesting one because it had been such a big winner, pulling back after making higher highs right around earnings.
Yeah.
It was interesting because there was some bearish options flow that kind of signaled this thing might be pulling back. But I do feel that if you're looking for what had been leaders and momentum plays, it's kind of a good way to dip your toe, the Iron Condor, with a bit of a bullish skew in it because it's mostly a volatility play with a drop of directional bias.
It really is. And yesterday, we put one out. I think we talked about it on the show yesterday in VRT. If you look at the chart in VRT, yesterday it hit those highs again that it has not been able to break through. Massive, massive resistance. So yesterday we did one, but we had a slightly bearish tilt to it where we sold, the call spread being closer to being at the money and the put spread further away, paying off again. Are they always going to pay off? No. Do you have complete risk definition to your trade? Yes, and you love doing it in this environment where you are able to capture a ton of expensive premium.
Yeah, I've liked these trades also because the defined risk part of it is very analogous to a poker player. I always like to frame it this way. It helps me think about it because it's about bankroll management. If I know I'm going to Vegas for the weekend and I got $5,000 or I got $1,000 or I got $10,000, right? I know what I can play, basically what game I can play. I can play the $100 buying game. I can play the $200 buying game.
Absolutely.
Know? And so you can structure these around how much you want to spend per attempt, basically, per pitch,
There's no question about it, because at different times, in different environments, there are different ways to strategize, different ways to play the market. I know when you're in Vegas, when you're sitting at the poker table somewhere, there's different strategies you're employing based on maybe who you're playing with, what the environment is like. And so it's the same thing right now. And the goal is not to hit a home run for me. The goal is not to knock it out of the park. The goal is to make these consistent profits with that limited risk. And that's exactly what we're doing.
That's right, and that's very much the tournament style of play in poker, which is just get past the bubble, make your money back, and try to put yourself in a position for a big trade at some point. The other thing I noticed about your trades between Micron and Vertiv, Scott, is it seems like you've got a little bit of like a data center hardware bias to your kind of more bullish leaning iron condors.
Well, you know what? I'm doing those, because there are specific supporter resistance, and I'm still finding that there's still pretty expensive premium in those types of stocks, even though earnings is behind. But because of the overall narrative in the marketplace with these types of stocks, there's still expensive premium. And that's where I am looking to harvest the most, which gives me the least amount of risk also.
Okay. Love the stock specific, Scott. Last thought on the macro. Today we have equity volatility up, even though the S&P is unch, and bond volatility, which is also remaining quite big.
Well, that's what it is.
With the 10-year 4.4. Tell me about that bond stock relationship.
I mean, we know the equities, trail or follow the bond market. Bond market volatility is very, very expensive. And all you have to do is look to the 2-year today, right? Whoever talks about a 2-year auction, right? It's an afterthought on most talk shows or whatever. Today, it was so poorly received, which means that institutions, the buyers, they didn't want to buy these bonds. 2 years. We're not talking about 10-year, 30-year, talking about 2-year. They didn't want to buy these bonds. And that was a tough one. And I think that is really reflective of the overall market right now, and just everybody watching this inflation narrative, what's happening in Iran, what is the Fed going to do, and what the probabilities of rates possibly going up. I'm not saying they're going up right now, but possibly going up somewhere down the road.
Yeah, it's amazing that right now the odds of the cut and a hike are basically the same. There it is. The
Unbelievable.
hike.
I mean, 3 weeks ago, you could have gotten really, really good odds on that.
Yeah, and it's a weird spot to be in. Are they going to cut or are they going to hike? Two polar opposite things. So
exactly.
I can see how that's going to keep some volatility in the market. All right, nice. Scan the code so you can get the freedom to ski and do hits at the same time. By the way, ChatGPT says still says copper on Friday.
Still says copper. I think you should go there and hit me up, because maybe I'll meet you there. But I know right now I'm looking at my family over there at the Red Lion in Vail, and they are waving me over there. So that's where I'm headed. All
right, love it. Though warning, if you come see me, I think I'm going to try and snowboard, Scott. Don't disown me as a friend.
Oh man, I gotta dissuade you from that.
Well, if there's no snow, then I don't think I'll have an option. Appreciate it, Scotty.
Exactly. Have a good one. Bye-bye.
See you, man. Good stuff. Scott Bauer, Prosper Trading Academy. All right, looking at the bond and the stock relationship, which is obviously very tricky right now, with roughly the same odds of a cut as a hike, which is pretty nuts. We got less than a minute into the bell. Equities in the S&P 500 are going to end the day lower. We did fade down. We lost the bid, but still nothing even close to what VIX maybe suggested in terms of how bad this could get today. There's the bell. S&P's drop 37 basis points, roughly 25 on the session. Thanks for tuning in to Chicago Future of Finance. We've got a great show tomorrow with the bell ringing here at SIBO. Have a great day or night wherever you may be. Good luck. See you at 2 p.m. Central Time tomorrow.